Hello again, everyone. This is Gene Aaronsberg coming to you from our HQ near Houston, Texas on Monday, January 21st, 2013. Well, it's Inauguration Day in Washington, D.C., and the people's choice, your president, has taken the oath of office. We find it ironic that the Prez swears to protect and defend the Constitution of the United States while simultaneously attacking the Second Amendment. But we will, mostly leave that comment there and let the freedom bloggers carry the torch. We do want to call out an important video posted on GotGoldReport.com which points out the most important reason that the framers of our national experience included the absolute right to keep and bear arms. The framers understood that power corrupts mere mortals. They understood that a government that becomes all-powerful will inevitably take all freedom from its subjects. They were very fearful of government having too much power, and rightly so. So as one of the most important checks and balances in the Constitution, they provided that the American people would always have access to arms in order to protect themselves from tyranny and governmental overreach. The basic idea is that the government is a lot less likely to attempt to mistreat its citizens if they can fight back. Defenseless people are sheep. Unarmed people are subjects to those in power. Just ask the Jews in 1937 Germany, the Russian people under Joseph Stalin, or the Cambodians under Pol Pot. The video is called Innocence Betrayed. You'll find it on the blog in both the Got Gold blog and in the Vulture in Review sections dated January 20th. Americans should not allow any further assaults on our gun ownership liberty. Resolve to vote out any politician that crawfishes or gives in to the anti-gun, big government left, without exception. Our liberty depends on it. We do not need more gun control. We need more control over government and to preserve our ability to resist as a free people. Watch the video if you dare. And enough about that for today. Let's look at where the metals ended this week. Moving to the closing table, gold ended the week up 1.3%, but seemed to be running into stronger headwinds. Silver outperformed, booking a 4.6% advance on positive technicals and reports of heavy physical demand. More about that in just a bit. Gold in euro terms also rose by 1.5%. Larger mining shares could not answer the metals this week. The Huey fell 0.7%. Smaller miners were mixed with the GDXJ green by 1.4%, but the CDNX was light red, down 0.4%. Finally, we call attention to the gold-silver ratio, which took a 3% dive this week on silver outperformance. It fell from a mid-54 to a high 52 handle in 1 week, as we have been expecting it would. Has the population come to believe all is well? Or has the Fed managed to force people to go into the equity markets by artificially keeping interest rates at absurd lows? All the money printing by the Fed, the ECB, the Bank of Japan, the Bank of England, and the ongoing race to debase fiat currencies, what James Rickards calls the new currency wars, does have consequences. We believe that means that more capital and liquidity will continue to find a home in precious metals looking ahead, as well as the stock markets. Looking at the subscriber daily gold chart, the wide flag formation continues to dominate the chart, but gold is pretty close to challenging the upper limits of it as shown. Notice that the 50-day moving average, currently about 1696, is once again being challenged. The last challenge, in November, was unsuccessful and resulted in a second turning high. As gold fell back into the Fibonacci 50% to 61.8% retrace box, we ended up taking a long position in 2 tranches, as shown by the asterisks, and reported it to our subscribers in near real time. The purple lines on the chart show the history of our trading stop placement. Looking at the moving average convergence divergence indicator, or what we call the MACD, we see that momentum is attempting to shift back to the bull side. The same is true now for the Relative Strength Index, or the RSI. Our current short-term trading attitude is that the trading stops have likely converged in large numbers in the red and green zones shown, with gold having now printed a marginally higher high on Thursday, January 17, just barely kissing the 50-day, and just under the flag downtrend line, or DTL, on our charts. Short-term swing traders have likely marked the 200-day moving average as a must-hold to keep them in the game. So if gold is unable to hold that red moving average line on a closing basis, sell stops and long trailers ought to kick in about where we have placed the red oval. That explains why we have moved our stop up to just above that zone. On the other hand, should gold manage to thrust above the 50-day moving average and the DTL in convincing fashion, there should be a good deal of buy stop and short trailing stops triggered somewhere near the green oval. Maybe not instantly, but a move above an obvious technical line in the sand is never something to ignore. We can look back to a similar setup last summer for instruction. Notice the breakout above the expected stop trigger, then a retest of the breakout 1 week later, followed by a strong surge of buying and short covering. It was a typical kind of textbook breakout. Subscribers, be sure and catch the new commentary on each of the subscriber charts each week. That's where we intend to do the bulk of our communicating going forward. Moving to the weekly gold chart, this is actually our favorite gold chart because it eliminates a lot of the noise in shorter term charts. There is not much change in the story since last time. As we said last time, gold has broken out of the giant flag consolidation and is now consolidating above the breakout point. But notice also that gold has actually closed above the 7-week moving average for the first time in 7 weeks. Bottom line for the gold chart view as of Friday, January 18th, we see gold correcting in a wide flag formation after breaking out of a much larger flag or pennant. As it tested the Fib 50-62 box, or the Fibonacci 50 to 62% retracement box, we decided to take a punt, a long position in 2 tranches. As of the end of the week, we had moved our trading stops up to just under the 200-day moving average. Should gold retreat and trigger stops just below the 200-day moving average, we believe there should be strong support in the former congestion area shown in the green on this chart. Call it the 1620s or so. Should gold thrust up above the 50-day moving average and the flag downtrend line, there should be considerable buying pressure coming in from the momentum crowd, as well as a good measure of short covering, especially by the funds or managed money traders. Before we move to the silver chart, this is an hourly view of gold courtesy of finviz.com. The only thing we want to call attention to is the attempted sell raid, which occurred coincident with the better-than-expected weekly jobless claims data on Thursday, January 17th. This sell raid hit a concrete floor and was summarily stuffed and reversed. So powerful was the buying counter-reaction that it moved up above the previous day's highs and even went up to test the January 2nd highs, very close to $1,700. Note the modest profit-taking Friday in this view. Moving to the daily silver chart for subscribers, it's similar to the gold chart in that as silver retreated in December to the Fibonacci 50 to 62% box, shown here in what appears on our screen as purple, we decided to take a 1-unit punt long in 2 tranches as shown. Let's zoom in. Once again, the purple lines show our trading stop history for this trade. As of Friday, January 18th, we decided to tighten our stop up to just under the 200-day moving average on the retest of the 50-day, and after silver marked a new high for this up leg. The green and red ovals are where we expect stops are bunching up. Looking up to the Relative Strength Index, or RSI, we note that silver is attempting to show a momentum change to favor the bulls. We can see an echo of that in the MACD below. Let's take a look. And there it is. We just wish it was a little more convincing than it shows today. Having said that, Here in the weekly chart, we can point to an interesting development. Silver has closed the week above the 7-week moving average for the first time in 7 weeks. This past week, silver actually cleared both the 40-week and the 7-week moving averages, pretty convincingly too. There have been persistent rumors and reports of intense physical demand for silver metal here and in overseas markets. Although we are hard-pressed to find evidence of that heavy demand in the futures strip this week, we can point to 2 important developments that do support the stories on the rumor mill. The first is that sales of U.S. Eagles at the Mint were so strong the Mint had to suspend shipments until the end of the month. And the second is that this week saw the largest one-day addition to metal holdings at iShares Silver Trust, known by its trading symbol SLV, since December 31, 2007, 5 years ago. On Wednesday, January 16th, SLV reported adding a whopping 571.63 tons of new silver in one day. That's about 18.4 million ounces of J.P. Morgan Chase London's hoard of LBMA-approved silver bars, having their name tags changed to SLV in one day. For the week, SLV reported a total addition of 601.68 tons of silver, which is a sudden 5.9% one-week increase to metal holdings. That's pretty big. We have to go back to November of 2010 to find a monthly addition as large as that one-day bump in metal holdings. In November of 2010, SLV added a total of 586 tons for the month. Then we have to go back to November of 2009 to find another month with more than 571 tons of new silver added. The point is obvious. Wednesday's increase to SLV metal holdings is huge. Something has changed. Incidentally, you may find this interesting. SLV currently holds about 345.1 million ounces, or about 69% of the amount of silver J.P. Morgan Chase London, the trust custodian, says it has room for under the current custodian agreement. That leaves room for about 154.9 million ounces, or about 4,800 tons of silver that could be stored without having to modify the agreement. If we add that to the current 10,734 tons, we arrive at a potential maximum of something like 15,534 tons of silver under current terms. For comparison, the highest amount of silver SLV has held in the past was on April 25, 2011, as silver was challenging its all-time high price near $50. SLV got up to 11,390 tons, or about 366.2 million ounces then. SLV is within 656 tons of its highest amount of accumulated silver, and about 4,800 tons of reaching the custodian's maximum. Moving on, one of the more important indicators we track is the positioning of the largest traders of gold and silver futures on the COMEX in New York. We can do that by looking at the CFTC Commitments of Traders reports and by charting the changes each week on the graphs we use to understand them. Looking first at the legacy COT report for gold, and that is for the combined commercial traders. That includes the producer merchants and the swap dealers. We can see that the number of net hedges, or the commercial net short positioning, peaked with gold's test of the $1,800 resistance back on October 2nd. Gold closed then at $1,774. Since then, up to last week, January the 8th, as gold retreated a net $115 from $1,774 to $1,658, the combined commercial traders reduced their collective net hedges by 90,798 contracts, from a very high 269,279 to 178,472 contracts net short. Let's look at that in graph form so we can see it visually. And here's the LC&S graph. So from October to last week, January the 8th, as gold corrected about 6.5%, the big hedgers were compelled to reduce their net hedges by 33.7%, about a 5-to-1 ratio. For each $1 in price reduction, the natural hedgers and the swap dealers combined covered or offset about 790 contracts. That was a brisk enough pace to entice us to attempt a long punt a few weeks ago as gold moved into the Fibonacci box on the graphs. Now, importantly, the relative commercial net short positioning, or what we call the LC&STO, has fallen from a very high 56% to just over 40% of all contracts open for the same time period. Here it is in graph form, the LC&STO. As subscribers know, we compare the LC&S with the total open interest on the COMEX in this graph. Remember, it peaked on October 2nd well up into the warning zone at 56%, with gold then in the 1770s. But as gold has corrected, the big hedgers have seen fit to reduce their hedges pretty sharply, as the graph shows. Just over 40% is still what we would consider in the neutral zone. But clearly, as gold has corrected this time, the motivation for those who literally have to hedge their price risk, their desire to hedge, if you will, has fallen at a faster pace than the pace of price correction. We view that as supportive of our decision to re-enter on the long side, right, wrong, win, or lose. Bottom line for the legacy COT report. It was pretty clear that the big hedgers were willing to throw heavy opposition at gold above, say, about $1,720. But as gold corrected back to below $1,700, and testing as low as the 1620s in early January, the combined commercials were motivated to strongly reduce their combined hedges. That simply means the commercials, the large metal dealers, the refiners, the producers, and the middlemen, the bullion banks they trade through, and all the other players in the gold trade, the largest, best funded, and presumably the best informed traders of gold metal on the planet, are all motivated to reduce their hedges in a meaningful way, with gold correcting from the 1770s to the 1620s. It does not necessarily mean they're right, but here we are given a window into their positioning to give us guidance on our own positioning. Even the big commercials cannot see the future. They don't know what the news headlines will be next week or next month, and neither do we. But we can see how they are positioning by tracking and charting their changes in the positioning, as we do here at Got Gold Report, and from their positioning we gain insight into what the largest traders are positioning for. That gives us a different, more comprehensive look at the markets than merely following a price chart or using technical analysis by itself. Let's take that same brief look at the legacy COT for silver futures. Since everyone now understands the program, we can go a little more quickly. Like gold, the combined commercial net short positioning for silver futures peaked October 2nd at a very high 57,840 contracts net short, with silver then trading in the 3450s. In the 14 weeks from then to January the 8th, last reporting week, silver corrected a net $4.23, or 12.2%, and the LC&S, or the combined commercial net short position, fell by 16,575 contracts to 41,265 contracts net short. Here's the LC&S graph. Compared to where it was in October and again in early December, the LC&S has come in quite a bit. But compared to where it reached last summer, with silver then testing long-term support near $27, it remains quite a bit higher. So as silver corrected 12.2%, the LC&S fell by 28.7%, about a 2.4 to 1 ratio. That's not really what we would call aggressive as a pace of LC&S reduction, but it is in the right direction. Let's look at the relative commercial net short position graph. So, meanwhile, the relative commercial net short position declined for the same period from a high 41.6% to an even 30%. That's in the neutral zone, but a lot better than it was in October. The LC&STO is well above where we might call it bullish, much less strongly bullish, relative to where it was last summer, near the 11.4% lows. But last summer was kind of an anomaly, coming as it did in the third leg of the big correction from its test of the all-time highs 2 years ago in April. If we look back to more normal periods, maybe we should say historic instead of normal, this ratio tended to find bottoms somewhere in the 22 to 33% range. So our view is that the ratio has been skewed by the very low readings in 2012 during the heavy corrective stage after the blow-off top. In fact, if you will remember, the very low point last summer was actually an 11-year low for the LCNSTO. What that means is simply that as silver corrected back to below $27, the big hedgers were so unconcerned that silver might move lower that their combined commercial net shorts only amounted to a tiny 11.5% of all contracts open in July of last year at the lows. That's why we said then that the LCNSTO was extremely bullish, and it's why we took a new long position which resulted in a great trade when we were finally stopped out in October. That excellent trade is still visible in the daily graph. The move up off the bottom near $26, which pretty quickly tested as high as $35, is the basis for the Fibonacci retrace box shown. Anything is possible, but we think we are very unlikely to see anything like that plunge in the LCNSTO to 11-year lows again anytime soon, until maybe after another parabolic surge and retreat sometime in the future. And now silver is once again challenging the 50 DMA from below after breaking out of a downtrending channel, bouncing from the Fib 5062 box. While we might wish that the COT was even more favorable than it is, we can say that the LCNSTO has fallen to the zone that has historically marked good support in the past. So, our trade lives as of Friday, January the 18th, and we have moved our trading stop up to just under where we believe silver should find good support on any near-term correction. Our thinking is that if silver cannot hold the 200 DMA now, we want out to the sidelines. Our suspicion is that the bears have more to fear than the bulls just ahead. Summing the silver picture up, as we run up against the clock for this video update, the legacy COT is much improved but not yet fully beat the table bullish. The technical picture is improving, and silver is within a small percentage of reaching a point where it ought to trigger buy stops and heavy short covering. Should silver manage to clear that obvious near resistance, there is a fairly large area of chart real estate before it would encounter significant implied resistance, call it near 3450 to 3550 or so. And above that would be the bear's last stand at something close to 3750. With so much heavy demand for physical and ETF silver showing, we think it's only a question of time before we see signs of it in the futures market. Signs such as backwardation between the cash and the near active contract, as we mention in our weekly notations in the GGR charts for subscribers. And if the trading gods throw us a curveball just ahead, and we end up being wrong with our assessment for gold and silver this time, as always, we will rely on our stops, our trading stops, to keep us out of trouble. As we sometimes say, trading futures without stops is like skydiving without a parachute. It's all about how the trade, or the jump out of an airplane, ends that counts, not the trip itself. No matter what, when trading fast-moving, highly volatile, high-leverage futures in short-term trading, our motto is, and always will be, mind your stops. Well, that's it for this Got Gold Report video. Subscribers, be sure to check out our weekly commentary in each of the GGR charts, as well as the daily comments on the welcome page of the subscriber site. You never know what interesting bit of actionable news might show up there one day. Till next time, stay tuned, good luck, good trading, and good vulture bargain hunting. We'll see you all again next time. Bye for now.